What's up everyone, it's Karthik with MoneyVest. So I've got a very important video for all of my subscribers and also all new investors that are getting started with investing in the markets. And that's exactly why I really want you guys to share this video, because it's an important message. And the problem is that obviously we are not a big channel, right? So we're just at 82,000 subscribers right now, and there's many channels out there that are much bigger and greater audiences and much wider user base that are of course creating the content on the market. And I actually took the liberty to watch a few and just want to get a general sense of the overall message from those channels and of course those videos as well. And unfortunately, what I've seen is that there actually seems to be a lot of bearish sentiment on the markets calling for this super big collapse or crash in the market. And that is exactly what I want to address in this video. And not to say that they are completely incorrect or wrong. In fact, if anything, they actually do share very useful and factual information. But sharing information or analyzing data and then coming to a conclusion about that data are two very different things. So we can analyze information and data that could lead us to a rabbit hole, which is the markets are going to crash and there's a big US collapse coming in. But that would be the wrong conclusion to arrive at, according to my analysis and according to historical data as well. So a better way to look at markets has almost always been being prepared for a potential economic downturn or a crash or a collapse, while also staying invested in the markets, because time in the markets always beats trying to time the markets or the tops or the bottoms. And that is the general messaging is what I want to get across. And from the beginning of our channel, as you guys already know from some of the older subscribers and members, you guys do understand that I myself am very optimistic about the future. I'm very bullish on the markets long term, right? I do get excited when we do see these sell-offs and the red in the market, because that gives us an opportunity to buy. But I would never ever recommend anybody, I mentioned this in the live stream as well, to sell their entire portfolio or to exit the entire market in an anticipation of a potential crash or a collapse, because nobody at the end of the day really knows where the markets are going to go. So this was one of the videos that I was able to watch from Game of Trades, which says history repeats, and they actually get thousands of views. We're talking 60, 70, 80,000, hundreds of thousands of views. And it's only a 6-minute video, but the general premise of this video was there's a big crash coming. US economy is going to collapse. There's a recession and the markets are not going to do super well. And they've actually posted a lot of videos. There's just not just this channel, but many channels talking about this big collapse or crash coming in the market. Now, I do understand, as a YouTuber myself, I do understand why this works, because bearish news and bearish articles and bearish headlines and a lot of fear sells, right? So fear is what gets a lot of clicks and the views and everything else. So I do understand why, they do it. And I am also guilty of doing it sometimes. Sometimes you'll notice my titles, thumbnails do represent a little bit of fear. But really, if you watch the content, I just want to get the general messaging across that yes, there is fear out there. Yes, there's panic out there. Yes, there's really bad news out there. But the general idea is to buy. Buy that fear, buy that panic, buy that oversold conditions, those discounts, those deals, buy into that. That is the main messaging that I want to try to get across, is because I myself am buying when the VIX is high, when there's a lot of fear, when there's a lot of panic. And long term, I know the markets are going to perform really well, considering this one thing continues to play out, and that is earnings per share, which we'll discuss in just a minute. But really, the reason why my heart breaks is because when you look at the general messaging, and there's thousands of new investors watching content, and there's actually one of the comments in that video from 12 hours ago, just crash already. 146 likes on that comment. That simply goes to show that people are sitting on a lot of cash, waiting for the markets to crash, waiting for the markets to come down, right? So that was the top comment, just crash already. Right? So that those three words in itself tells us what? People are waiting for a crash. The word already represents they're too sick of waiting, right? So they've been waiting a long time, and they're sitting on a lot of cash to buy, right? So Peter Lynch, as you already know, one of the most famous investors, said this: far more money has been lost by investors preparing for a correction or trying to anticipate corrections than has been lost in corrections themselves. And you can replace that word corrections with a crash also. Far more money has been lost by investors waiting for a crash than the crash themselves. And what that means is that's the opportunity cost that you have by sitting in cash, right? By just waiting and not investing when you should be, right? And I've got a lot of really important stats to break down in this video that are going to help you. And that's exactly why I really want you to share this video with new investors to better understand. And this is more geared towards, your average investor. We're not talking about somebody having a significant edge of trading, trying to be able to anticipate when the market's going to drop, so they move into defensive and then move back into more aggressive investments as we are risk on. So we're not talking about those tactical traders that are trading with an edge. We're talking about the average layman people, that are just average people, average investors, basically. That's going to be the majority of us, right? Majority of people that just want to invest for the long term and not really move in and out of investments, trade in and out of investments to generate alpha. People that are happy and comfortable with an 8 to 10%, 12% returns per year, which is actually pretty solid. That's a very, very solid return. So, always remember this quote from Peter Lynch, because I think it's really, really important. And this right here is the other side of the story. But before we get into that, let me just break down one particular stat, which is timing the market stat, right? So the cost of timing the market or moving in and out of trades in anticipation of what is going to happen next, right? So if people are expecting a crash to take place, and they're just sitting out, they're holding off on investing in the markets because they believe that the market's going to crash or they're going to see better opportunities, guess what happens? If you simply miss out on the 10 best days for the market, right? So 7 of the 10 best days took place in the bear markets themselves. So if you simply sit and wait for the markets to keep going down and not buy and not invest, look what happens. Your returns are getting cut in half. So this right here, the first bar, is when you are invested on all days, right? So regardless of what happens in the market, whether it goes down, up, sideways, in circles, doesn't matter. You're invested all days. Look what happens over time. Your $10,000 is over $64,000. Now let's see that you just miss out on the 10 best days for the market. For example, S&P 500 last week, up over 5%, right? How many people do you think took advantage of that? Not a lot, because if people are waiting out on a much bigger sell-off, if they feel like, oh, this is nothing, this is just a dead cat bounce, we're not going to be invested, we're going to be waiting, we're going to be sitting on the sidelines. If you just miss out on those simple gains, and that compounds over time, and by missing only 10 best days in the market, your returns go from $64,000 down to only $29,000. So that's pretty much getting cut in half. Now look what happens when you miss 20 best days, and now you're looking at only $17,000. Missing 30 best days, 30 best days in the S&P 500, and now your returns are barely anything. Barely anything. It's only 10%, $11,700 compared to $64,000 had you been invested throughout all the volatility, all the market volatility, right? So that is a significant difference in those returns. If one person simply invests and holds throughout those days of S&P 500's market volatility, coming down, going up, and going sideways, and eventually, of course, coming up to all-time highs, that person does significantly better, 6 times returns on their original investment versus somebody that is simply trying to time the market, getting out when they feel there's a market crash coming, and then get back in, and then once again do that same process over and over again, and that person's return are only $11,700. So, and then of course, it only gets worse if you are sitting out the market more and more days. So this is a very good representation of why it is the worst idea to try to time the market, liquidate, sell everything if you believe there's a market crash coming, and sit out in cash, right? And then of course, then you have another problem of when to get back in. So bad timing can take a bite out of your returns. Below are the risks of trying to time the market and simply missing out the 10 best days an investor could lose majority of their overall return. So I think it's really, really important to identify and realize some of these really important levels. So I've actually posted a video on liquidity framework, and this is some of the liquidity levels that I think everyone can follow. And this is mostly geared towards investors or people that might be operating at a level where, you know, they've got underinvested levels here, meaning that they are incredibly underinvested, waiting for a market crash. They've got over 50% in cash available to them, and they're just sitting out. They're just literally sitting out. They're waiting a crash, and they're not invested at all. And my question to you is why? Like, why? What are you? What kind of edge do you have to anticipate a market crash? And that unfortunately is what those videos eventually end up doing, right? They're counterproductive, because yes, you're learning more about the economy and the markets and all those different stats, but they're also keeping you out of the market. They're also keeping you out of the market by not allowing you to take advantage of the market rallies that we're seeing. So look, my job here is to make you money. My job literally on this platform is to help you make money, help you generate income, help you invest in your future, and help you achieve a financial future and financial fulfillment. That's my goal. That's my objective. And every video, everything that I do is going to be geared towards that goal, is to help you make money. And unfortunately, you're not going to make money if you're not investing in the market. So this is, again, geared towards people that may be underinvested, sitting on too much cash, not taking advantage of those buying opportunities when the markets do sell off in anticipation of a much bigger crash. And my question to you is why? Why? Right? So that's why I want you to share this video with other investors, especially newer investors that might just be getting started and they're too fearful or too scared to invest in the markets in anticipation of a much bigger crash, because they may have stumbled upon any of that content, or even on Twitter, there's a lot of threads and posts suggesting for why the markets are going to crash further. More money has been lost anticipating a crash than in the crash itself. Always remember that. And if you just miss out some of the best days in the market, you are going to really diminish your returns overall over the long term. So a much better place to be in, okay, is to be somewhere between cautious over here. So where I like to personally operate is somewhere between 5 and 30%. 30% might also be very, very high in terms of cash levels, but that is a level that I feel very prepared and I can take advantage of those opportunities. And that's also a 30% level where I'm not selling stock to raise cash. I'm adding more cash from my income. I'm selling calls to generate some more income. So that is cash that I'm adding into my portfolio. This is not when I'm selling stock to raise my cash. In very, very rare circumstances, I would sell a stock, or I would sell any position to raise my cash exposure so that I can be prepared for a potential market pullback or correction. And even then, I'm not expecting for the markets to drop 50, 60%. Because in those videos or in those threads, they may be talking about this being another tech bubble and the market's going to drop 70, 80%, and that's when you start going in. Folks, that is a very, very rare occurrence. You have a much better odds of winning the lottery maybe than actually anticipating a market crash similar to what we witnessed in the 1990s. Or even in the Great Financial Crisis. So the odds of that happening is extremely low. It's like a black swan event. And if that were to ever happen, you'd be prepared. You'd be prepared. I mean, you would have 20, 30% in cash. You can actually dollar cost average significantly more, add more money, through your income. You will be prepared. And that is a black swan event for which the probability is really low in happening. So why waste your time being underinvested, waiting for something that is a very, very low likely outcome or low probability outcome, and miss out on all the potential upside there? It just doesn't make sense from a risk reward standpoint. So where I like to operate, like I said, is somewhere between cautious and prepared, somewhere between 5 to 10%. And that is also not happening by me selling stock, but instead putting more money into my portfolio through my income, through my savings, and also by selling calls and increasing my income, and of course, raising my cash exposure. And this is after I have already achieved 6 to as much as 24 months worth of expenses saved up in a high yielding savings account. That's my emergency fund. And this is a cash that if I need something, if there's an emergency, if something happens, I can dip into my savings to fund those emergencies, right? That's what that's for. So that puts me in a sufficient / secure / a robust position. So this is a liquidity framework which I think everyone should be following on some level. If you are comfortable with 6 months worth of savings and you feel sufficient and you want to be 90-95% invested, that's totally up to you, and that's normal. And defensive, again, 10 to 20% cash. Prepared is 20 to 30% cash, but I really wouldn't dip into too much. Anything over 40 to 50%, of course, as much as 60, 70, 80% seems to be very, very underinvested in my opinion, and that creates this lack of returns, and this opportunity cost is very, very high, especially when the markets are correcting and they're pulling back. That's when you see the wildest returns from the market. And this right here was fairly new, just a few hours ago. We're in the early stages of a bull market, says Wedbush analyst Dan Ives, in terms of technology. And he says that we're in the early innings of a potential bull market in the S&P 500, and of course, more specifically, technology sector. So that's the idea. And Tom Lee's also mentioned time and time again. So it's almost always been a profitable trade, trading on the long side than it's trading on the short side. I ask Michael Burry. He's been, he has been famously renowned as the big short investor, making money on the downside of the great financial crisis. But since then, the markets have ripped, and he has, of course, not participated in that rally, rotating in and out of different positions. I mean, just compare the returns of Warren Buffett versus Michael Burry, or somebody like Howard Marks, or even Peter Lynch, compared to the short investors like Peter Schiff or Michael Burry. It's just, the odds are very much stacked against you if you are betting on a market crash and anticipating a pullback or a correction and just waiting out in cash. So a much better way to look at things, I think, would be this, and this is what I like to personally follow, is that when I see fear, when I see panic, when I see red deals, discounts, and the volatility is high, we're coming down to oversold levels, undervalued levels, my by default is buy, right? My personal action or decision making is geared more towards buying opportunities and using that fear, using that panic, using that red, using that deals, discounts in the market to dollar cost average and buy. Now, when I do see the opposite of that thing, right, when I see greed or euphoria or green or expensiveness or overvaluation, overbought conditions, do I sell? No. Right? Very rarely, like I said. And this is just really me simplifying to the very, I'm really, really dumbing it down, but this is, of course, not as simple. There's different things like portfolio allocation, rebalancing, right? So Warren Buffett just sold 49% of his Apple stock, when it was at an all-time high. So does that mean to never sell? No, that's also not what I'm saying. And I'll go over that in just a minute. But this is what I like to follow personally, is buy when there is a lot of fear and panic in the market, and not sell when there is a lot of greed and euphoria, but instead just hold, and also sell covered calls and raise more cash, right? I would never want anyone to sit out of the market and sell their entire portfolio in anticipation of the crash. That's the whole point of this video that I'm trying to explain. Now, let's dive right into the most important thing, and that is earnings, okay? Everything that we talk about, everything, whether it's related to recessions or the Japan carry trade, the unemployment increasing, inflation rising, whatever crisis you can plug in over here. You can input whatever crisis, whatever you hear in the media, whatever you see in all of these videos or Twitter threads or whoever you're listening to. You can simply put in your crisis here. You can input that. And all of it boils down to just one simple question. How will this impact earnings? That's it. That's it. Because if you are investing in individual stock, you can ask the same question. How will this impact the earnings for the company? How will this impact the earnings for the S&P 500? Because at the end of the day, we're investing for profit. And profit is what matters most. It's the bottom line. It's quite literally the bottom line. And it's also the bottom line for financial statements. It's at the very bottom, right? It's earnings. It's net income. It's profit. How will that get affected if XYZ were to happen? If we see recession, if we see Federal Reserve raising interest rates, if we see Japan carry trade unwinding, if we see unemployment going up, if we see a depression, if we see inflation going up, hyperinflation, deflation, whatever crisis you can input right here, blank, and how will that impact earnings? Once you start to answer this question, you will much better understand how much value does it really have. So what I've done here is I've essentially broken it down into very simple terms, what a price to earnings really is. A PE multiple, right, is price over earnings, as we already know. And I wanted to break down all the different scenarios of how when a price moves and an earnings move, what does that do to the valuation, which is what we know the price to earnings multiple. So this right here is going to be the breakdown, meaning when the price remains constant, it is where it is, and earnings remain constant, the PE multiple remains constant, because at the end of the day, it is price divided by earnings. And I've given you a simple example here. Let's say the price is 20, earnings are 2, PE multiple is 10, because we're doing 20 divided by 2, it's 10. If it remains at 20 and earnings remain at 2, PE multiple remains at 10, right? That's the valuation, which is constant if both of those things are constant on the numerator and the denominator. If the price increases and goes up and earnings are constant, let's say that this goes from 20 to 25, now the P multiple goes up. It goes from 10 to 12.5. So P multiple goes up in that scenario. If the price goes up, let's say it goes from 25 to 28 and earnings go down from 2 to 1.5, P multiple goes up again. It goes up to over 18, almost 19 now, right? So P multiple goes up. If the price is constant, for example, it's at 28 and earnings go down further, let's say that it goes down to 1, now we've got P multiple going up even more. It's at 28 now. It went from 19 to 28, right? So price earnings multiple goes up. Now, if price is constant at 28, earnings go up. Let's say they go from 1 to 2. Price earnings goes down. So back down to 14 now, right? Because earnings went up and price remained constant. So you can see P multiple went up to 14. If price goes down, so let's say that it goes from 28 down to 20 again, and earnings remain constant, P multiple should go down. So it went from 14 now down to 10. And if price goes down further, let's say it goes back down to 15, and earnings go up, let's say that it goes from 2 to 3, now P multiple goes down further, down to 5. Now, this is a good metric for you to understand how valuation fluctuate. And higher the P multiple, the worse it's going to be from a valuation perspective. The lower the P multiple, the better it is going to be from a valuation perspective. Now, I want to be very clear. And again, I'm really just simplifying this down to the very bottom. But a low P multiple does not mean it's undervalued, and a high P multiple does not mean that it's overvalued. There's other factors at play, but this is really just to give you a bit of a sense of how price and earnings really dictate the P multiple, and what that can do to the perception for investors in terms of whether an asset or stock or security is overvalued, undervalued, or fairly valued. So that's how the P multiple would move in the case of price and earnings going up or down or remaining constant. Now, let's just go over one more scenario where both of them are going up or both of them are going down. That's the only thing that we haven't discussed. And that depends on the delta, meaning the percentage of increase for price versus percentage of increase in earnings, and what is more and what is less. So if you come back to the simple example again, price is 20, earnings are 2, P multiple is 10. Now, let's say that price increases by 10%, earnings increase by 10%, so they're both increasing by the same number. Price to earnings remains constant at 10, because 20 price increasing by 10% gets up to 22, and earnings from 2 to 2.2, that's a 10% increase, and now we are sitting at the same price to earnings. So it remains constant because they're both going up at the same level. Now, let's say that price goes up faster. Let's say that it actually goes up by 15% and earnings only increase by 10%. In that case, the price to earnings should go up. So now we got 10.45. If I bring up the decimals, now we got 10.45 compared to just 10 over here, because the price went up faster than earnings. Both of them went up, but price went up faster. Now, let's say that earnings actually increase faster. Let's say the earnings go up by 20%. Now this P multiple should go down. If you hit enter, you'll notice 9.58 actually went down. Why? Because earnings in the denominator are growing at a faster rate than price, growing at 15%. Same thing is true for when they're both going down. So let's say that price goes down by minus 10% and earnings go down by minus 10%. So they both are going to be constant again, because we are both going down at the same magnitude or the same delta per se. But let's say that price goes down faster. Let's say that price decreases by 20%, earnings are only down 10%. In that case, the P multiple goes down because the numerator is going down faster than the denominator. And let's say the earnings actually go down faster. Let's say earnings decline by 30%. In this case, the P multiple should go up because earnings are going down faster than the price. And in that case, you can see that it's back up over 11.4. And the verdict is P multiple going up in this example. So hopefully in this video, you get a bit of a sense, bit of an idea of how the PE multiple changes based on price and earnings, right? So this is a great, you can take a screenshot, you can keep that in your notes, and again, better understand how everything boils down to the earnings, and depending on how the earnings move, that's going to very much correlate with the price, right? Of course, price and earnings don't always move in correlation with each other. One can be forward looking, the other one maybe a little bit more lagging. But at the end of the day, as we have already analyzed, S&P 500 is nothing but a multiple of earnings. So for example, right now, if you're trading at 55.50 and the earnings per share for this year are at 250, the current P multiple for S&P can be at 22.2. So if earnings come down, if there's any recession fears, if there's unemployment going up, Federal Reserve raising interest rates, whatever the case might be, and earnings come down to 200, take a look at the P multiple. It goes up to 27. All of a sudden, you are now looking at a market which is a little bit more expensive than where it was when the earnings expectations were really high. So I hope that makes sense, because everything is going to be a product of its price and earnings, and that is the multiple that we're looking at. And it gives you a bit of an idea, a better idea of how the markets are trading. And the lower it gets, the better it is going to be from a valuation perspective. So for example, S&P comes down to 5,000. Now we're at 25. Earnings expectation, let's say increase to 240. Now we're at 20. So that is a fairly valued market based on historical data. So the bottom line is, I would stay invested, not try to time the market. That's the message. Yes, there's going to be corrections and pullbacks along the way, but in anticipation of that, don't sell your stocks. Don't short the market. Don't buy puts. And this is more geared towards average investors, right? If you're investing for the long term, trust the process, stick to the plan, and long term, of course, the probability is very, very high for you coming out on top and making money in the market. So that's all I've got for you today. Don't be scared of investing in the markets. Don't be out of fear that markets are going to crash. We're going to see another 60% sell-off, so I better sit in cash. The probability is very, very low. It can happen. It's possible, but the probability is incredibly low. And investing and trading is all a game of probabilities. So hope you all enjoyed this video, found it helpful. Make sure you drop a like, subscribe, and share this video with your friends and family. I'm sure people can benefit from this message. Happy investing. I'll see you all in the next video.